realistically, the major issue here is, yes, if people live too long, but now the question is, do I lose my money? So let's walk you through that. You will lose earnings. So let's walk you through here. If somebody invested with us $100,000 and they owned 5 policies, and let's say they're going to get back $180,000 from when those people pass away, right? You have your $100,000 principal and $80,000 worth of gain. If everybody in this round passes away before or when they should pass away, or even slightly less, you're going to get that 180. What you would need is all of these people who are already unhealthy, they would all have to live beyond their life expectancies. And then you start to see that you would lose gain. Hello, everybody. I'm Ben Mohr, and welcome back to Truly Diversified, show where we talk about alternative investments, a way to make decent returns without any stock market risk. You know that I work with a company called lifeassetllc.com, if you've ever listened to the show before, where we help people invest in what's known as life settlements. It's a product that Warren Buffett has invested in for decades. It's where a lot of big banks, Deutsche Bank, Credit Suisse, named a few, have invested millions, if not billions of dollars into this asset space. And again, just to recap for you, what is it that a life settlement is? It's where somebody buys out a person's current life insurance portfolio or their insurance policy, and then the new person who owns it gets paid when that person passes away. So let's work through kind of an example of one. Let's say you had an 80-year-old named John Smith. He has $1 million life insurance policy, right? It's permanent. It will pay out. It's not term. And he needs end-of-life care. So what he does is he goes to Warren Buffett, or he goes to the company I work with, Life Asset LLC, and they negotiate a settlement, meaning that he will give up his rights to that life insurance for a certain amount of money. Usually that's going to be maybe $300,000. So now John Smith has his $300,000, uses it for end-of-life care, and now Warren Buffett, let's say if he owned it, he just sits and waits to see when the person passes away, and then deals with the premiums, the payments to pay for the policy while that person's still alive. Essentially, that's how it works. Now, with Life Asset LLC, it's slightly different because you're not going to buy a full policy. You're going to buy into a portfolio of policies, usually 5 or 6. And so that means that you have a small amount of money. You don't have to come up with $300,000. You could invest $25,000 or $50,000 and spread that $50,000 over 5 policies, right? So less exposure for you, less percentage of ownership. And you don't have to pay the premiums on these as they go, because part of the money is going to be put in a reserve account through the company to pay premiums. At some point, if they do live too long, you may have a premium call. They've happened before, but most of the time we've done things to mitigate risk to make that from happening. Okay. And, but that isn't really what this show today is about. I just want to give you a recap, because I came on here today kind of impromptu, because I just did some dinner seminars recently, and I found I hadn't done one in a while. And I just thought it was interesting, some of the questions that people ask that are out there. And then I thought maybe you as our listeners had those questions too. Funny thing is, I've been in the industry so long and I know this product so well that some of the questions that are asked, and they're, people are just throwing out questions. So I don't think they're really sitting thinking of this. They just learned about it. I just told them in, 10 minutes what this is. So they have just a real 30,000 foot view of what this is. So I'm not thinking that these people are being malicious trying to ask some question that's just ridiculous. And I don't think that they're like dumb, that they just are asking questions like that are like, it's 1 + 1 150. I just think that they don't have the knowledge. So it's a natural response. I probably would ask the same questions if I was in the audience too. It's just being on the other side of the fence and knowing everything about this product. These questions kind of, you just sit there knowing what I know going, wow, I can't believe that question was asked. So I want to explain it, and I explained it to them too, and they finally understood. One of the persons raised their hand and said, look, I see that there's 5 policies in these portfolios. I see that they're 78 and 82 and 84 years old, but I get screwed here on this deal, if these people all live to 150? Okay. Yes, that was a question asked. And I know they're being facetious. They're throwing a number out there that was so hyperbolic, right? But even take it to 100, right? I've been in this business a long time, okay? And what I can tell you is, number one, let's look at the people that we bought the policies on, right? None of these people are even averagely healthy for their age. These are people who have, medical issues that leads us to believe, because we send their reports out to get a life expectancy report from a medical doctor who tells us how likely it is this person's going to pass away. And all of these people have been verified through those doctors' reports that they are not even average health for their age. Think about that for a second. Let's talk about our John Smith, 80 years old. For us to buy his policy, he can't even be the average health of an 80-year-old. Think of any 80-year-old you know, right? If they're going to the gym, they're most likely healthier than the average 80-year-old, okay? If they're even out there being active, they are more than healthy than the average 80-year-old. We're not even talking about an average 80-year-old. We're talking about somebody who has health issues making them less healthy than the average 80-year-old. And we're expecting that that person might actually live to 110, 120, 130. It's kind of slightly absurd, but I understand. Let's look at why that person would ask that question. Realistically, what they're asking there is, do I get screwed if these people live too long? And that's the core of the question, and it's a great question, okay? So we need to look at that number one, there is longevity risk in buying in a life settlement. The beauty of the product overall is that it doesn't have the same type of risk factor that you're used to when you invest in what you've invested in your whole life. The market it has no effect on this product, right? And that's what you're used to, the ups and downs of the market, the economy, and that's why people buy into this, because all of those average usual risk factors that you have dealt with for the last 10, 20, 30, 40, 50 years of investing do not exist here. Realistically, the major issue here is, yes, if people live too long, but now the question is, do I lose my money? So let's walk you through that. You will lose earnings. So let's walk you through here. If somebody invested with us $100,000 and they owned 5 policies, and let's say they're going to get back $180,000 from when those people pass away, right? You have your $100,000 principal and $80,000 worth of gain, okay? If everybody in this round passes away before or when they should pass away, or even slightly less, you're going to get that 180. What you would need is all of these people who are already unhealthy, okay? They would all have to live beyond their life expectancies. And then you start to see that you would lose gain, meaning your 100,000 is your base. Maybe if you get in a situation that just isn't very good, which I've rarely seen, maybe you get 170, maybe you get 160, you still get gain. Remember, you have to bring down through premium calls all of that $80,000 to get to your first dollar, right? Think about that. How long these people, if premiums are already paid to these people's life expectancy, these people all would have to live for a very, very, very long time to get to a point where $80,000 of money got eaten up in premiums before we hit $1 of your money. Let's talk about today in the stock market. You could put $100,000 in the stock market today. It could have a bad day and you could see that you have $95,000 in the market. Day one. In this case, to get to $95,000 of your $100,000 invested, it would take a very long time, and it would take 5 unhealthy people for their age group to defy the odds. Now, I have to sit here because I'm going to act like a regulator or someone is listening to every word I say. So I want to make sure I say this. Is that possible? Absolutely, it's possible. But I talk all this time to people, like when I talk to my kids about possibilities and probabilities. I live in the world of probabilities, okay? Because this is all math. It's possible. I live in Orange County. Today, it's 72 degrees outside. Okay? stop gambling your retirement future on the stock market. I've helped many investors just like you make millions of dollars with double-digit returns without placing one single penny in the stock market. Look, this is a proven strategy that ultra-wealthy, savvy investors like Warren Buffett have used for decades to hedge against stock market risk. So if you're interested in learning how to make competitive returns without stock market risk in an investment that is not affected by politics, worldwide events, or economic woes, all you have to do is simply click on this link below to learn more. Looks fine. This is how it is in Orange County in, the fall time. Is it possible that if I walk out my door in an hour, there's going to be a 5-foot snowstorm from a blizzard? Well, it's never happened here, but it is possible. We can't say it's not possible, right? Your weatherman tries to tell you what the weather's like. It is a forecast, but in California, it's pretty easy a forecast, right? I mean, yeah, we have our storms. I think we have a storm actually coming up, and every once in a while. But here in Orange County, it's most likely pretty easy. I wake up in this time of year and I know it's going to be 68 to 74, cloudy during most of the early day, and then it burns off about 2 or 3. That's the world I live in because that's probable. That's probable. But there is a possibility it could snow tomorrow. Never happened, I don't think, in Orange County at this time of year, but it's possible. That's what we're dealing with here. Is I can't get rid of the possibilities of theoretical things happening, but we have to look at the probabilities. I've personally in my business have never seen that happen ever, where people have bought this product and see their gains completely eroded away to where they've had $1 lost in their principal due to people living long and long and long. I've dealt with literally probably hundreds, maybe if not 1,000 policies during my lifetime. I've never seen anybody reach the age of 100. 100. And people are asking about, well, what if they live forever, right? So if I'm telling you that in that source of people, hundreds and hundreds of policies, or even say 1,000 policies, I've never even seen anybody crack 100, right? What does that tell you? Because remember, you're probably sitting there going, oh, well, I have a grandma that lived to 101, and I've got a grandfather that lived to 102. Guess what? At 80, you know what they were? They were healthy. We would have never bought their policy, right? No way. I have people go, I have a grandma who's so healthy at 95, that's why I wouldn't buy this. And I go, you're not understanding. We would never have bought her policy at 80, because if she's healthy at 95, she was really healthy at 80. We're dealing with people who are already unhealthy at 80. They've not made great choices, or their genetics have just caught up with them because of their families. They're not going to change their lifestyle at 81. If they're sitting on their couch watching Judge Judy reruns, eating terribly and depressed because maybe their spouse has passed away and just life is kind of done for them. They're just existing. That person is not going to wake up tomorrow, take their Silver Sneakers membership, get down to 24-hour fitness, and start jogging marathons in 6 months. It's not going to happen. That's what happens. People are habitual. This is what they do. Okay? So that is a question I get asked literally every dinner. Like, what if they all live to 110? What if they live all 120? The issue there is, come on, let's be realistic. The data shows us that's probably not going to happen because these people are already unhealthy, and the statistics show us from us being in the business, it already hasn't happened. And even if it did happen with certain cases, you would have to have a real calamity situation to even burn through the earnings. You wake up day one when you invest in this product currently, put $100,000 in, you're going to get back 180 if things happen the way they should. If they don't, yes, that 80,000 could slowly erode. But the issue is you got to go through all that $80,000 worth of gains to get to your first dollar. So I can't sit there and tell people, yes, you could lose money. No, yes, you can't lose money. Of course you could lose money if everything went wrong. But you got to ask the next question is, how often has that ever happened? And the answer is it hasn't. In my experience, it has not happened. I can't sit here and say that people had to keep paying premiums because everybody lived to 100. So it's kind of ridiculous. But I understand. It's the fear-based question of longevity. Okay, so that is an issue. The second question real quick is I ask people go to me, Well, what happens if the insurance carrier goes out of business? Okay. That is, I think, insurance is so boring and people know so little about these companies that they don't understand how strong they are. So let's back up and look at what insurance carriers are. What do insurance carriers do? Insurance carriers literally buy out bonds. Okay, that's one of their main areas where they make money. There's other things that I'm making this very simplistic, but what they do is they invest in bonds. If you understand bonds, that's like almost like a loan to a company. So you have a large company out there and they're building something and they need $100 million. They can go to an insurance carrier. Insurance carrier can write a check. They're getting a higher return than you or I would normally do because they're writing the full check. And so when you look around at all these major corporations around the world, most of them have a bond that they offered to an insurance carrier. Okay. And those insurance carriers are getting paid by them on that contractual deal. They usually like long-term bonds, like a 10-year deal. So that's what they do. Now, the thing is, let's back it up. If you were to invest with us, say $100,000, okay, and you have 5 policies, that means that like in one certain policy, in any of these policies, you might have about $20,000 invested in that policy for that insurance carrier. So number one is we only deal with A-rated carriers. We don't deal with companies that are C-rated, stuff like that. A-rated strong carriers with a long history of being in business. Okay. So one of the carriers that we've dealt with in the past is New York Life. Okay. You know what New York Life is, but you probably don't know how powerful New York Life is. So let's say that we had a round where the New York Life policy and your money is in there and you go, geez, I don't know if I can sleep at night because I've got $20,000 invested in a policy with New York Life. I sure hope they don't go out of business. Well, let's break that down. Okay. New York Life has been around literally since the early 1800s, number one. So kind of would be weird if they made it, in fact, through the Civil War and the Depression that we had in the early 1900s, that there's going to be some cataclysmic situation that makes New York Life all of a sudden go out of business. Here's another thing. Think of Bank of America. When everyone thinks of Bank of America, they think, wow, I mean, no one would raise their hand at a dinner of mine and just ask randomly, do you think that Bank of America is ever going to go out of business? Do you think the government would ever let Bank of America go out of business? That sounds like the most snugly safe institution we have. Well, you can Google it because I did it today. Do you know how much Bank of America is worth? Bank of America is worth about $300 million. That's a lot of money. That's a lot of money. I mean, that's more, I'm sorry, $300 billion. 300 billion, I mistake there, with a B, billion, $300 billion. That means that they are large enough to be probably a country, right? I mean, they would be one of the strongest countries in the world. Well, guess what? New York Life, I Googled it too. They're worth 800 billion. 800 billion. That's right. They could buy and sell New York Life, or they could buy and sell Bank of America, okay, New York Life. But no one thinks about that. So when someone raises their hand and says, what if the insurance carrier goes out of business? Should they be laying awake at night? Let's say this person is worth $1 million and they have $20,000 of their money invested in this one policy with this one insurance carrier. Should they be laying awake at night about 2% of their net worth sitting there when they have more money than any mutual fund than 20%? Or $20,000 or 2%. Should they be laying awake at night worrying about that? Absolutely not. Here's the other thing I told that gentleman. I said, okay, in this scenario that I laid out, all those companies, I don't want to say all, but many of the companies that you've invested in the stock market, okay, have a tie to these insurance carriers through bonds. A lot of them do. Why would be the reason that a New York Life could fold? Because they're not getting payments. The payments have been defaulted to them from the companies that they invested and loaned money in can no longer pay them because those companies have gone belly up, right? Right. Okay. So that means the companies that you have money in the stock market have gone belly up, so they can't pay New York Life to pay off your $20,000 investment with us. I turned to this person and said, sir, if New York Life was to fold, most likely your stock portfolio would drop by 2/3 overnight. We would be in a severe depression. Whether you invest with our company or not, if insurance carriers go out of business, which it rarely ever happens, Banks go out of business way more often than large A-grade insurance carriers, by far. If they fold, that means because the companies on Main Street are no longer making money. Your money is invested in those Main Street companies through the stock market. You are getting absolutely crushed in your stock market portfolio. Okay. So regardless with us, what you do with us, if New York Life was to fold, your stock portfolio is in the dump. Absolutely. You are sucking wind. And you're going to worry about the $20,000 that's held over there in a policy. It's just extremely unrealistic. It's not something people should worry about. But again, we get to the possibility versus probability. Possible? Is it possible that a company like New York Life could fold? Well, we saw in 2008 a lot of banks that we never saw would fold. They did. So, of course, it's possible. But I'd say a company that was formed in the early 1800s worth $800 billion in today that is giving out loans to large companies that you're aware of, I just don't see that happening. It's extremely unrealistic, but it's of course possible. It's extremely not probable. Okay. Those are the two big things I get asked all the time. Right. So I hope that clarifies it. By the way, I love the questions they asked because, they just don't have the knowledge yet to work it through. And by the way, I talked to both those people and they set appointments to meet with me. So obviously they finally kind of understood how I walked them down the logical path, right? But their questions were great, and I'm not picking on these people at all. I'm just saying it's questions I get, and it's because they don't know, and really it's fear-based, which is how do I lose money in this thing? A, because people live too long, or B, because the insurance carrier goes out of business. So what I have to do is kind of round these people up and look at it and go, well, how possible is that? It's not very possible. It's almost unrealistic to happen. So I just wanted you at home because I think some of you might have those questions as well, because it's an unknown, an alternative investment, and those are the answers. So number one, is everyone going to live to 150? I can't say the word guarantee here on the air, but I can almost say it, that it's very, 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 very likely, knowing that no one on the planet's ever lived to 150, that you're not going to buy a policy that someone lived to 150. Same thing there is, can I sit there and say that New York Life or John Hancock won't go out of business? I can't guarantee it, but I'm very, 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 very confident they won't, right? Because they've been around for a long time and they have a lot of assets, okay? So that's the answer there. So hopefully it clarifies it. Just kind of food for thought today on that is some of the questions I get asked at dinners and thinking, I bet you my listeners at home are also wondering those same things. So let's clarify it. So there you go. Hope you enjoyed that, and we'll see you next time here on Truly Diversified. Okay, have a great day.